Hello, welcome to this chapter again. Question number 13. We'll practice one more question. 13 number taken from your study material. All study material questions write down important. Question number 13 taken from your study material of the institute. A Limited, B Limited and C Limited decided to jointly construct a pipeline to transport the gas from one place to another that was manufactured by them. So this is one more practice on jointly controlled asset. For the purpose following expenditure was incurred by them. So building was constructed at 12 lakh, depreciation 5%, pipeline 60 lakh, depreciation 15%, computer and other electronics 3 lakh, depreciation 40%, vehicles at 9 lakh, depreciation at 20%. They also decided to equally bear the total expenditure incurred on the maintenance of the pipeline, which comes to rupees 6 lakh each year. So each venturer will also bear 2 lakh rupees. There are 3 venturers, so each will bear 3 lakh rupees expenditure related to maintenance of the pipeline. So what are we supposed to do? Show consolidated balance sheet. Now here consolidated balance sheet means what is the total assets and total capital. Okay, this is not the consolidated balance sheet in the usual sense. In usual sense, consolidated balance sheet means parent company and its subsidiary company. In this question, there is no parent, no subsidiary. In this question, no new entity is created also. So this question itself is wrong, or they could have simply written memorandum consolidated balance sheet, because there is no balance sheet as such of the joint venture. It is a jointly controlled asset, no new entity is created. Still, whatever assets are there, we will write it. Second is extract of the statement of profit and loss. Again, this is how much profit or loss this joint venture has made. We have to show only the extract. There is no revenue in this problem, but there are two expenses. One is depreciation and one is maintenance. And then this is okay question, balance sheet of each venturer. How these items will appear in the balance sheet of each venturer. Now if they ask you something, then you have to respond. For example, consolidated balance sheet, that is how much is the total asset of the joint venture after providing depreciation. So write down first answer. I am going to write the answer so that you can understand better. If you want to write the answer along with me, you can write now, open a notebook. If you want to write later, you can write later. The answer is printed in the book. Choice is yours. Follow me or you can do yourself. So first what you will do, first we are answering the first answer. Consolidated balance sheet. Okay, consolidated balance sheet, you can simply write draft. There is no need to prepare a consolidated balance sheet as such for a problem like this, because there is no new entity created. So we will write first format, serial number, particulars, note number and rupees. Serial number 1, and I am going to explain equity and liabilities. Under equity and liabilities, you write down shareholders funds, write down under that share capital, and this we will write later. Amount I will put later. And part 2 write down, it is just an extract, assets. Under asset write non-current assets. Under non-current asset, write property, plant and equipment. Under non-current asset, write down property, plant and equipment. This you write note 1, this you write note 2. Below that you will prepare notes to account, because in this question there is nothing much. Whatever are the assets, write it down. Whatever are the liabilities, there is no liability and there are assets. So note to account, first column note number, second column particulars, and then two columns. So I have to prepare two notes. First note is share capital. This I will write later. You just write the name of three venturers right now. I will come back to share capital later, because right now we don't know share capital or shareholders fund. Point number 2, write down property, plant and equipment. Property, plant and equipment. Under that we have 4 property, plant and equipment item. First one is building. Building. Now how much is building? How much is building? Total building is 12 lakh. Total of the building is 12 lakh and depreciation is 5%. So you will take calculator, 12 lakh minus 5%, that comes to 11 lakh 40,000. 12 lakh minus 5%, and there are 3 venturers, so you write their name: A Limited, B Limited, C Limited. Right below A Limited, B Limited, C Limited, 11 lakh 40,000 divided by 3. So each venturer share in the building is 3 lakh 80,000. 3 lakh 80,000 each. Now we'll write down point number B. Point number B, write down second asset is plant and machinery. Plant and machinery, the cost of the plant and machinery is this is in bracket pipeline. The cost of the pipeline is 60 lakh. 60 lakh minus depreciation at 15%. Minus depreciation at 50%. 60 lakh minus 15%. 60 lakh minus 15% is 51 lakh. And then there are 3 venturers: A Limited, B Limited, C Limited. Each are entitled to 1/3 in that. Divide by 3. So you will write 17 lakh. 17 lakh. 17 lakh. This is pipeline cost. Now the next asset is computer and other electronics. Computers and other electronics. Now what is the cost of computers and other electronics? It is 3 lakh. And the depreciation rate is 40%. So that comes to 1,80,000. And then under that we have 3 companies: A Limited, B Limited, C Limited. Divide by 3. So each venturer is entitled to 60,000. And there is one more asset. There is one more asset, and that is vehicles. The cost of this vehicle is 9 lakh. Question in front of you. 9 lakh. Depreciation 20%. Depreciation 20%. So that will come to 7 lakh 20,000. And again you write the name of 3 venturers A, B, C. 7 lakh 20,000 divided by 3. So they will write, each venturer will record 2 lakh 40,000 share in the asset. And then you write down total PPE. You will have to add, I will highlight, you will add 11 lakh 40,000 plus 51 lakh plus 1 lakh 80,000 plus 7 lakh 20,000. Please take the total of all these 4 assets and give me the answer. Yes, what is the answer? 71 lakh 40,000. 71 lakh 40,000 is the total asset. 71 lakh 40,000. So share capital will also be 71 lakh 40,000. And you divide by 3. So share of all the 3 venturers will be 23 lakh 80,000. This is how this 71 lakh 40,000 share capital has come. Otherwise the student will wonder how share capital 71 lakh 50,000. They have done nothing. Total assets divided by 3. This is just for presentation. As I have told you, if it is a jointly controlled asset, there is no consolidated balance sheet as such. It is only for understanding how much is the stake of each venturer. Each venturer stake is 23 lakh 80,000 in the assets of the joint venture. That's it. So this is about consolidated balance sheet. The second part of the question is, extract of the statement of P&L account and balance sheet for each venturer. For each venturer you have to prepare their P&L account extract and you have to prepare their balance sheet extract. So I am going to do it for A Limited and you are going to do for B and C as homework. B and C homework, because you just have to copy paste the same thing, because all figures are also same for each venturer. So now the student will write books of A Limited. A Limited is venturer, profit and loss statement. Answer is printed in the book. If you don't want to write, then focus on understanding. If you want to write, you can write now, you can write later also. So this is my extract of the P&L account. Note number rupees. So there will be 2 expenses. There will be 2 expenses that we are going to present. One is depreciation and amortization. Depreciation and amortization. And second, I will present other operating expenses. Other operating expenses. This I can write 2 lakh rupees outer column, and for depreciation I will prepare working note. Note 1. In other operating expenses you write down pipeline maintenance. Pipeline maintenance. And how this 2 lakh has come? 6 lakh divided by 3. 6 lakh divided by 3. Each venturer will incur 1/3 of the total 6 lakh. So I need to prepare note number 1 for depreciation and amortization. Then you write down balance sheet, in bracket extract. In balance sheet we will write note number, amount in rupees, asset side, non-current asset. We are going to record our share in the assets of jointly controlled asset, and PPE. Note number 2. Note number 2. Okay, note number 2. Then we'll write down notes to account. Notes to account. Note number, particulars, rupees. Note number 1 is depreciation. Depreciation is on 4 items: building, plant and machinery, computers, and vehicles. So I'll come back to this. Keep 2 lines blank and then you write down PPE. Under that we will write, first A will write building. What is the total cost of the building? Total cost of the building is 12 lakh. Divide by 3. Share of A Limited in the building, gross 4 lakh, less depreciation at the rate 5%, that is 20,000. So this will be 3,80,000. 3,80,000. Only for presentation we have to write all this. Point number B, the next asset was pipeline. PPE bracket pipeline. Take on your calculator, pipeline cost is 60 lakh divided by 3. 60 lakh divided by 3, 20 lakh. Less depreciation at the rate 15%, that is 3 lakh. So this will be 17 lakh. The third item was computers and other electronics. Computers and other electronics. Total is 3 lakh divided by 3. 3 lakh divided by 3. 3 lakh divided by 3 is 1 lakh. And less depreciation at the rate 40%, that is 40,000. So that comes to 60,000. And one more item, write down vehicles. Take on your calculator, 9 lakh divided by 3. 9 lakh divided by 3, 3 lakh. Less depreciation at the rate 20%, and that comes to 60,000. Total 2,40,000. Take the total of the PPE item. Take the total of the PPE item, that is 3,80,000 plus 17 lakh plus 60,000 plus 2,40,000. So that comes to 23 lakh 80,000, and also write down depreciation on building 20,000, this figure, on plant and machinery 3 lakh, this figure, on computer 40,000, on vehicle 60,000. So the total of the depreciation is 60 plus 40, 1 lakh, 3 lakh, 4 lakh 20,000. This is your notes to account. So write down 4 lakh 20,000 on the main page over here, and in the balance sheet you write down 23 lakh 80,000. This way the student has to present the answer nicely and he will get full marks. Question is from the study material, so question becomes important. Homework, write down, complete the presentation in the books of B Limited and C Limited on your own. Nothing will change, not even one word will change, only the name of the company would change because each of them have equal share in assets and expenses. So that was about jointly controlled asset. Okay, now we'll take question number 14. Question number 14, source, write down study material and also write important. If the source is study material or past exam, those questions are very important. Okay, so let us solve question number 14. A Limited, a UK based company, entered into a joint venture with B Limited in India, wherein B Limited will import the goods manufactured by A on account of joint venture and sell them in India. A and B agreed to share the expense and revenue in the ratio of 5:4 respectively, whereas the profits are distributed equally. A Limited invested 49% total capital but has equal share in all the assets and is equal liability for all the liabilities of the joint venture. Following is the trial balance of the joint venture at the end of the first year. Following is the trial balance of the joint venture at the end of the first year. Now they are saying purchase, other expense, sales, property, plant and equipment, current asset, unsecured loan, current liabilities, capital. Closing inventory was valued at 1 lakh. Question is, you are required to prepare the consolidated financial statement. Now this question is not properly drafted. Why? Because we can't prepare consolidated financial statement. Consolidated financial statement means financial statement of parent and its subsidiary, and if there is a jointly controlled entity, that will also be consolidated using the proportionate consolidation method. But in this case, what they are trying to say is to prepare the financial statement of this joint venture, which is like a normal 12th standard accounting question. This is your trial balance. If you are a 12th standard student and this trial balance is given to you, how would you prepare the profit and loss statement? Exactly the same thing you have to do. Of course, you have to prepare in a proper schedule 3 format. So disclosure part will be elaborate, but there is nothing great about this question. If this question was in the books of the venturer, then it was a different matter. Okay, then each venturer will record his share as agreed in the assets, liability, income and expense. So we'll have to prepare P&L account and balance sheet. Financial statement means P&L account and balance sheet based on whatever is appearing in the trial balance, and there are very few items appearing in the trial balance. So write down, please. Write down. First write down consolidated, although it is not technically correct to call it consolidated profit and loss account, but because they have used this term, I will also use it. And draw the format first. Draw the format first. All of you, please follow me. If you practice along with me, it will be good. So first you write down revenue from operations. First you write revenue from operations, one line blank. Point number B, write down expenses. Under expenses you write down small a, purchases, then small b, other expenses, and small c, change in inventories. Although you should have written change in inventory above other expense, but welcome to the institute. So I have tried to keep the same format, but ideally change in inventory should have been written before other expense, and then point number C would be your profit before tax. Profit before tax. So this is a small P&L account because there are not many items in the trial balance. And now we are going to prepare. We will write down note number 1, note number 2, note number 3, note number 4. They are saying in revenue and expense the sharing will be 5:4. Profits are distributed equally and has equal share in all the assets and liabilities. Both the venturers have equal share in all the assets and liabilities. So consolidated balance sheet now. Consolidated balance sheet, same format. Serial number, particulars, note number, rupees. So it is like solving a problem of final accounts rather than a problem of joint venture, because you are given a trial balance and you have to just convert that into P&L account and balance sheet. So nothing exciting in this question, just it's a lengthy question because of the presentation part. So write down shareholders fund, under that A, share capital, note number 5, B, reserve and surplus, note number 6. Point number 2, if you keep the question in front of you, it will be better. Non-current liabilities. Non-current liabilities, under that long-term borrowing. That long-term borrowing will include unsecured loan. So we'll call it note number 7. Then next point number 3, write down current liabilities. Under current liabilities, you don't have any further breakup, so just write down note number 8 and we'll take total of the liability side. Part B, write down assets. Under asset 1, write down non-current assets. Under non-current asset, write down property, plant and equipment, note number 9. Then point number 2, write down current assets. Under current asset, write down A, inventories, which is note number 10, and B, other current assets, which is note number 11, and then we'll take the total. So these are my formats. Now I am going to prepare notes to accounts, and in the notes to account we are also going to show the breakup of all these items between the two venturers. The name of these two venturers are A and B. So that is the purpose. Note number 1, revenue from operation. Note number 1, revenue from operation, and we have two venturers. So as per the instruction given in the problem, third line of the question, A and B will share the revenue and expenses in the ratio of 5:4. Total revenue in the question is, if you see sales, 13,05,000, and you have to take 5 by 9, 4 by 9. 5 by 9 is how much? 7,25,000. 1305,000 into 5 divided by 9. 7,25,000. And the second one is 4 by 9 of 13,05,000 is 5,80,000. So write down on the main page, P&L account, revenue from operation 13,05,000. Then we'll come to note number 2, purchases. Under that 2 points A, B, every time do the same exercise. 5 by 9, 4 by 9. Purchases is 9 lakh. 9 lakh into 5 by 9. Very easy. 5 lakh, 4 lakh, total 9 lakh. So purchases, write down 9 lakh. Purchases, write down 9 lakh. Then what is the third note? Other expense. Note number 3, write down other expenses. Under other expenses, write down A Limited, B Limited. Take on your calculator 5 by 9. 5 by 9 of 3,06,000. So that is coming to 1,70,000. And then you write 4 by 9 of 3,06,000. That will come to 1,36,000. So this total comes to 3,06,000. Main page, other expense 3,06,000. In the main page, other expense 3,06,000. Then note number 4 is change in inventory. There is no opening stock, but there is a closing stock of 1 lakh. There is a closing stock of 1 lakh given below the trial balance, and the problem says the two venturers will share all assets and liabilities equally. So closing inventory, note number 4, closing inventory, note number 4, A and B, this we are going to divide equally, 1 by 2, 1 by 2. As per instruction, this is asset 50,000, 50,000 and 1 lakh. So my next answer is 50,000 here, that is in bracket, sorry, 1 lakh. closing stock 1 lakh in bracket. Opening stock is 0, closing stock is 1 lakh. Opening stock minus closing stock. Total of point number B will be 9 lakh plus 3 lakh 6,000 minus 1 lakh. So that comes to 11 lakh 6,000. And then profit before tax will be 13 lakh 5,000 minus 11 lakh 6,000, and that comes to 1 lakh 99,000. So profit of this venture is 1 lakh 99,000. Now we'll come to next point, is your note number 5, share capital. Note number 5, share capital. A limited, B limited. A limited, B limited. How much share capital A has contributed? 49% of 4 lakh 1,000. Take 4 lakh 1,000 into 49%. 49% is given in the question. So that is 196,490. And this fellow 51% of 4 lakh 1,000. So that comes to 2 lakh 4,510. So this is how the two venturers have contributed in the share capital. So you write down 4 lakh 1,000, main balance sheet, share capital 4 lakh 1,000. Note number 6, write down reserve and surplus. Under that write down A limited, B limited. They have made a profit of, can you see, 1 lakh 99,000? They have made a profit of 1 lakh 99,000. There is a note in the problem in the third and the fourth line, whereas profit and profits are distributed equally. So 1 by 2 of 1 lakh 99,000, that is 99,500. So that comes to 1 lakh 99,000. So students will write 1 lakh 99,000 on the main balance sheet. Next, note number 7 is long term borrowing. Long term borrowing, if you look at the trial balance, we have one item under long term borrowing, and that is unsecured loan, and under that we have two companies name A and B. All liabilities will be distributed equally, so divide by 2. 2 lakh divided by 2, 2 lakh divided by 2 is 1 lakh. So long term borrowing 2 lakh in the main balance sheet. This is how we have done up till now. Next item is note number 8, current liabilities. Note number 8, current liabilities. Under that write down A limited, B limited, 1 by 2, 1 by 2. Current liability is 1 lakh. Divide by 2. 50,000 each. That is 1 lakh. So current liabilities write down 1 lakh. At the top you can see on the right side. Now you take the total of the liability side. That will be 4 lakh 1,000 plus 1 lakh 99,000 plus 2 lakh and plus 1 lakh. So that total comes to 9 lakh. Total is 9 lakh. Now we'll write down note number 9, property, plant and equipment. A, B. Total of the property, plant and equipment is 6 lakh. Divide by 2. Each venturer, as per the agreement, is entitled to equal share in assets and liabilities. So 6 lakh, 6 lakh, and this 6 lakh you write in the balance sheet, asset side. Next, note number 10 is inventory. Already written, but one more time. Inventory A, B, half share each, so 50,000 each, that is 1 lakh. Inventory on the main balance sheet, write down 1 lakh, and the last item is other current asset. Other current asset, note number 11. Note number 11, other current assets. Under that you write down A limited, B limited. Total of the other current asset is how much? Inventory current asset is 2 lakh. So 1 by 2, 1 lakh each. Total is 2 lakh. You can see current asset in the trial balance. Fifth item, because we have written inventory, all other current asset will be written as other, 2 lakh. So write down 2 lakh here and take the total and write 9 lakh. This is all this we have done for presentation purpose. How much is the profit of this joint venture? What are the assets and liabilities of the joint venture, and how these are shared between the venturers? That was the objective of this question. Now we'll come to the third category of joint venture, which is called jointly controlled entity. Students are requested to come to paragraph 9, jointly controlled entities, JCE. It means here two venturers, let us say there are two venturers, venturer A, venturer B, they form a joint venture. A new entity is formed. A new separate legal entity is created. This will be running as an independent company. Okay, it will be registered either as a limited company or as a partnership or as an LLP or a private limited company, but it will have its own separate legal existence, and it is jointly controlled by two or more venturer. If it is a jointly controlled entity where a new separate legal entity is created, then it is called jointly controlled entity, and these two venturer will follow proportionate consolidation method. Venturers will follow proportionate consolidation method. What is proportionate consolidation method? Each party will record its share of asset, liability, income and expense. As far as this new entity is concerned, it will follow all accounting standard as usual. It will follow all accounting standard. It will maintain its own books of account. It will prepare its trial balance. It will prepare its own financial statement, because it is maintaining books of account under double entry system like a separate entity. Once it prepares its financial statement, it will be used by the venturers A and B for the purpose of proportionate consolidation. Point number 3 on the screen, a jointly controlled entity maintains its own accounting record. So it will have all the accounting record that is required: cash book, day book, purchase day book, sale day book, journal. It will prepare its own trial balance. It will prepare its own financial statement, just like any other enterprise. Now I want to make it very, very clear, this standard is applicable in the books of venturer. What we are learning is accounting treatment of financial reporting of interest in the books of venturer. This standard does not deal with how the joint venture entity will do the accounting. Okay. Joint venture entity, the new entity, will follow all other applicable accounting standard. One example of jointly controlled entity: ABC Limited in India establishes an outfit in Germany. So a new company is formed in Germany with 33% contribution in asset, balance being contributed in euro by a German enterprise. German enterprise ABC have formed a company in Germany. Profit sharing arrangement is 1:1. The purpose of the venture is to gain a foothold in the German market. So that is the objective of this joint venture. You will get a foothold in German market, you will be exposed to German customer, so that the products of ABC with the marketing support from German outfit can be made in Germany. But this new entity is a separate entity, and this type of arrangement is called jointly controlled entity. Now what about the accounting treatment? Para 10. As far as separate financial statement is concerned, venturer's separate financial statement, AS 13 will be followed. Investment in joint venture will be presented under accounting standard 13. So that will be presented as a long-term investment, and all the rules of AS 13 applicable for long-term investment will become applicable here. And what about consolidated financial statement? First thing keep in mind, this portion is applicable only if the venturer is preparing consolidated financial statement. That is, the venturer should have a subsidiary. The venturer should have a subsidiary. So if the venturer has a subsidiary, it is preparing consolidated financial statement, and then in consolidated financial statement it will consolidate joint venture by applying proportionate consolidation method. So if a venturer does not have a subsidiary, it will not prepare consolidated financial statement, and therefore it need not follow proportionate consolidation method for jointly controlled entity. So what do you do in proportionate consolidation? In proportionate consolidation method, as the name indicate, you are going to record in the consolidated balance sheet share of the venturer in the asset, liability, income and expense. That means if you are a 50% stakeholder in a joint venture, you will record 50% of asset, 50% of liability in the balance sheet, 50% of revenue and 50% of expense in the profit and loss account. That is called proportionate consolidation method. When will proportionate consolidation method not be followed? So this paragraph was there in AS 23 also. You have a jointly controlled entity, but the standard says you need not apply proportionate consolidation method. When? This is a theory question also in the book at the end. When the interest in joint venture is held temporarily. Underline, temporarily means the objective is to dispose in the near future. The objective is to dispose in the near future. And second is an interest in joint venture which suffers from severe long-term restriction and significantly reduces its ability to transfer funds to the venturer. or second is when you have made an investment in joint venture, but joint venture has come under severe long term restriction, severe long term restriction, and it is not able to transfer funds to venturer. Example, I repeat, I had given in the earlier chapter also. You may have a joint venture in Afghanistan. Afghanistan is now controlled by Taliban. Talibani government has said no outflow of funds from Afghanistan. They have banned all foreign remittances, and therefore the joint venture entity is not able to transfer funds to the venturer. So what venturer will do? Venturer will not follow AS 27. Venturer will continue to follow AS 13. Venturer will continue to follow accounting standard 13 if proportionate consolidation method is not being applied. Next question is how to compute goodwill or capital reserve. Good news, we will follow the same formula which we have followed in AS 21 and AS 23. So the formula for computing goodwill or capital reserve is, you are going to compare the cost of acquisition with the share in the net asset on the date of acquisition. Same point, compare cost of acquisition with share in net asset on the date of acquisition. Now there are two possibilities. Cost of acquisition may exceed net asset, you will call it goodwill, and second possibility, share in net asset exceed cost of interest in joint venture, it means it is called capital reserve. Nothing different in other standard also. Okay, so I am not taking one immediate example here. Cost of acquisition 1 lakh and share in net asset of joint venture is say 50,000. So this will be goodwill 50,000. Reverse, this is 1 lakh, but share in net asset you got 2 lakh. So 1 lakh difference, this we will call capital reserve. So same format will follow, we'll solve in some question, you will get it. So let us solve first one question on proportionate consolidation method. You will find this question number 9 in your book after 2 or 3 or 4 pages. So all of you please come to question number 9. Source, write down reference book. Source, reference book. We want our student to practice more, and if you practice more, you will score more. And at your level, they are going to ask only basic and fundamental questions. Question number 9. Major Limited and Minor Limited have set up a joint venture called JV in the ratio of 40% and 60%. So Major Limited is holding 40%, Minor Limited is holding 60%, but because it is more than 50%, Minor Limited will apply AS 21 and Major Limited will apply AS 27. Minor will apply AS 21, it is holding more than 50%. Now the question says both major and minor are required to prepare consolidated balance sheet. The balance sheet of both the co-venturer and joint venture are given below. So this is the balance sheet of major, minor, joint venture. Let us look carefully. These are their own share capital, no problem. Share capital of joint venture is 1 lakh. Reserve of joint venture is 50,000. Now this joint venture was set up by these two companies. So this reserve will be fully post acquisition reserve. This reserve will be fully post acquisition reserve because it's a newly formed joint venture. So whatever reserve is created is only after the creation of the joint venture. So entire 50,000 is treated as post acquisition, loan, fixed asset. Now look at the investment, tick mark. Out of 1 lakh, 40% is held by major, 40,000, and 60% was contributed by minor, so that is 60,000. So that is matching also. Out of 1 lakh, 40,000 was contributed by major, 60,000 was contributed by minor. Then net working capital total. Show the reporting of joint venture in consolidated financial statement of major limited and minor limited. Is it right? So you have to prepare consolidated financial statement for both parties. Major limited will follow AS 27. Proportionate consolidation. Major limited will follow proportionate consolidation. Minor limited will follow AS 21. Full consolidation. Full consolidation, also called line by line consolidation. Line by line consolidation. So first I am going to explain what major limited is going to do. Major limited will first compute goodwill, but there is no goodwill. In the books of major limited, calculation of goodwill will be equal to cost of acquisition minus share in net asset. It has acquired for 40,000 and the share capital is 1 lakh into 40%. It was a newly formed venture, so there was no other asset. So the answer is 0. There won't be any goodwill or capital reserve, okay, in the books of both the parties, because it is 1 lakh and they have contributed 40 and 60. No question of goodwill or capital reserve. So how the balance sheet of major limited would look like, I will explain, then you can see the answer. Share capital will remain the same, 5 lakh, but reserve 3 lakh, and you are going to add share of major limited in the reserve. So that is 3 lakh and plus 40% of 50,000. So reserve will appear 3 lakh, this one, and 40% of joint venture, which is 20,000. So reserve will appear 3 lakh 20,000. What about loan? 2 lakh own loan and 40% of joint venture. So 2 lakh and 40% of 30,000, 12,000. So total loan will appear 2 lakh 12,000. And total of the balance sheet will be, please take on calculator, 5 lakh plus 3 lakh 20,000 plus 2 lakh 12,000, that will be 10 lakh 32,000. What about fixed asset? 8 lakh, and you will take 40% of 1 lakh 20,000. 40% of 1 lakh 20,000, so that will be 48,000. So total fixed asset will be 8.48 lakh. Now investment will not appear, because against investment we are recording assets and liabilities of joint venture. So So investment and asset and liability both you can't record. It will be double counting. Net working capital will be 1,60,000 plus 40% of 60,000. So that will come to 1,60,000 plus 24, 1.84 lakh, and my total will be 8,48,000. Take on calculator, plus 1,84,000. Oh my god, the answer is same, 10,32,000. So very minimum adjustment you have to do. Again I repeat, share capital keep it as it is of major, reserve add post acquisition reserve of joint venture multiplied by your share, loan own loan plus 40%, fixed asset own fixed asset plus 40% of joint venture. This investment will not appear because against investment only we are taking assets and liabilities, and same thing net working capital 1,60,000 plus 40%, and my total comes to 10,32,000. So this is how the answer would look like. So students are requested to check the answer. Just write a note here, write down, prepare balance sheet in schedule 3 format in the exam. Second note here would be no goodwill or capital reserve will arise. No goodwill or capital reserve will arise. Now if you have any query on this part, you can ask me. The next part is consolidation of JV with minor limited. Minor limited will follow AS21. I am explaining minor limited, answer is printed, so you have to only understand goodwill. Goodwill will be investment in subsidiary, 60,000 minus 60% of 1 lakh, 0. Same answer for minor limited also, goodwill is 0. And one more working note they will prepare is minority interest, because now you are a parent company but holding only 60% share. For the 40% you will have to compute minority interest. So minority interest will have two calculation: share in share capital, which will be 40% of 1 lakh, 40,000, and second, share in reserves. I hope you have studied AS21. If you have not studied AS21, then don't try this question, then it will be difficult. So that is 20,000. So total minority interest in the consolidated balance sheet will be 60,000. So now what will be the consolidated balance sheet of minor limited? It will follow AS21. I repeat, it will follow AS21. So 3 lakh share capital will appear as it is. Reserve, this 1 lakh and 60% of 50,000. 60% of 50,000, 30,000 plus 1 lakh, 1,30,000. Loan, 1 lakh plus 30,000, full consolidation, line by line consolidation, 1 lakh, 30,000, and one minority interest will also appear let me write it below, but it should be written above the loan, which I have done in your book. Minority interest will come 60,000. Total of the liability side, take your calculator, 3 lakh plus 1,30,000 plus 1,30,000 plus 60,000, and that comes to 6,20,000. Very easy, I don't have to explain much. Fixed asset 3,50,000 plus 1,20,000, 4,70,000. Investment will not appear. 90,000 plus 60,000. Net working capital 1,50,000. Total of the asset side again 6,20,000. Very easy. Very easy. AS21 is followed in the books of minor and AS27 is followed in the books of major. I have given the answer also. You can check the answer. Consolidated balance sheet of minor limited as per AS21. Any query? Just write a note. Prepare balance sheet in schedule 3 format in exam. Prepare balance sheet in schedule 3 format. That you can do. Okay, same answer you can do. And homework, solve in notebook. Solve this question in notebook for exam purpose. Such basic questions can be expected from the student. Okay. Now we'll come to question number 15, which is from your study material, which is from institute's study material. Very important, because all study material questions are important, and you'll find it is very similar to the one I have solved. A Limited entered into joint venture with B on 1:1 basis. Very easy. Both partners are having equal stake in the joint venture, 50%, and a new company C Limited was formed for the same purpose. So this is an example of jointly controlled entity, because a new entity was created, and the following is the balance sheet of all the three companies: A Limited, B Limited, C Limited, share capital, reserve and surplus, loan, current liability, and then it says property, plant and equipment, investment in JV, tick mark. And this is the share capital 5 lakh. So both partners, both venturers have contributed 2,50,000 each. So there will not be any goodwill or capital reserve, because this is matching, and they have formed a new company. So there was no reserve and surplus at the beginning. There was no reserve and surplus at the beginning, no goodwill or capital reserve. In this question, both venturers will follow AS27. Prepare the balance sheet of A and B under proportionate consolidation method. Okay. So first note, no goodwill or capital reserve will arise. Second, both venturers will follow AS27. Both venturers will follow AS27. Both venturers will follow AS27. Right? So let us solve together. I am going to solve in the books of A Limited, and you are going to solve in the books of B Limited. A Limited I will solve, B Limited the student will solve, and only you have to prepare the balance sheet. Goodwill will not be there, minority interest will not be there, So please come to balance sheet of A Limited. You should write consolidated balance sheet because you can't follow proportionate consolidation method in separate financial statement. First we'll draw the main format followed by notes to account. In the exam also you will do the same thing. Write down, please. Write down in your notebook so that you will learn more. First draw the blank format. Equity and liabilities. Question is from study material so that you can, if you practice on your own, you will understand more. A, write down shareholders funds. Under shareholder fund, write down share capital. Note number 1. Note number 1. Then you write down point number 2. Reserves and surplus. Reserves and surplus. Note number 2. Point number B, write down non-current liabilities. Question in front of you. Non-current liabilities. Point number 3, non-current liabilities. Okay. Note number 3, non-current liabilities. Point number C, write down current liabilities. Note number 4. Then we'll take total. Assets. Under assets, write down 1. Non-current assets. A, property, plant, equipment. Note number 5. Point number B, current assets. Note number 6. So this is my format of the balance sheet. Complete the balance sheet part first, and now we'll come to below the balance sheet notes to accounts, where we'll write the details. Note number, particulars, rupees and rupees. First note is share capital. Authorized, not given, dash dash, double underline. Issued, subscribed and paid up. Details are not given, so just write down 10 lakh. 10 lakh you write on the main page also. Balance sheet liability side, share capital in detail 10 lakh. Now write down note number 2. Reserves and surplus. Under that you write down A Limited. A Limited's own reserve. A Limited's own reserve is 18 lakh. And point number B, add share in post acquisition reserve of C Limited, which is 50% of 12 lakh. If you write the calculation along with me, you will understand. I know the answer is printed, but in the answer, lot of calculations are not disclosed and the student can get confused. So this is a question from study material, you have to respect it. 24 lakh transfer to the main answer. Note number 3 write down. Non-current liabilities under that write down loan, then under that write down A Limited loan is 3 lakh and C Limited will take our share only, 50% of 2 lakh. See, the calculation is not given in the institute material. The student can get confused. In AS 27 you have to do proportionate consolidation. So this comes to 4 lakh. Transfer 4 lakh to the main page. Note number 4 write down. Current liabilities, same presentation. A Limited own current liability is 4 lakh and in the C Limited we have 50% share, so we will write 50% of 1 lakh, that is 50,000. So this total comes to 4 lakh 50,000. Then note number 5 we have, first to write 4 lakh 50,000 on the main balance sheet, take the total, that is 42 lakh 50,000. Note number 5 PPE. A Limited own PPE figure is 30 lakh 50,000 and in C Limited we will take our share only, 50% of 19 lakh. So the calculation 9 lakh 75,000. So that comes to 40 lakh 25,000. Write on the main balance sheet 40 lakh 25,000. Note number 6 write down current assets. A Limited full 2 lakh. You can see in the trial balance last line, balance sheet last line, and C Limited, so the calculation 50% of 50,000, that is 25,000. Only your share, that is called proportionate consolidation method. 2,25,000 main page. Now take the total. You will be happy to note that the total is tallying 42,50,000. So those who have not recorded can record now. Otherwise the answer is printed. I have explained. Homework write down. Homework, balance sheet of B Limited homework. Balance sheet of B Limited homework. Same process you will follow. Same process you will follow. Only this A Limited figure will be substituted by B Limited's figure. And then your answer will be same. So question number 15 is over. Balance sheet of B is homework. One more question we will practice. Question number 11 taken from past exam. This is a good question for learning purpose. Okay. So all of you are requested to follow me and write the answer nicely. This is a 16-mark question in November 2010 exam. 16-mark question. This question is not in your current study material. but if it is asked in the exam, you should be able to solve it. It is a mixture of AS21 and AS27. Question number 11 is Air Limited, a listed company, entered into an expansion program on 1st October 2009. On that date, the company purchased from BAG Limited. Company purchased its investment in two private limited company. The purchase was entire share capital of Cold. Air Limited acquired 100% share capital of Cold and 50% of the share capital of Dry. On 1st October, it acquired 100% share capital of Cold and 50% share of Dry. Both the investments were previously owned by another company called BAG Limited. Okay. Now this line is important. Underline, after acquisition by Air Limited, Dry Limited was to be run by Air and BAG as a jointly controlled entity. So Dry Limited will become jointly controlled entity. And what about Cold? Cold will become subsidiary because 100% shares are acquired. 100% shares are acquired. So I will summarize. Cold will become 100% subsidiary of Air Limited and Dry Limited will become a jointly controlled entity where 50% share is held by Air and 50% is held by BAG Limited. Air Limited prepares its financial statement up to 30th September. Each year the terms of the acquisition were. So now they have acquired Cold Limited. Now details of Cold Limited is given to you for the purpose of computing purchase consideration. The total consideration was based on price earning ratio of 12. Applied to a reported profit of 20 lakh for the year 30th September 2009. So you will start writing in the notebook. Step 1. Step 1, simultaneously understand also purchase consideration paid for Cold Limited, which is our subsidiary. Now what is the formula? Price earning ratio of 12 is applied to a profit of 20 lakh. So purchase consideration would be, I am going to write rupees in lakhs. Purchase consideration would be, purchase consideration is equal to 12 P ratio multiplied by 20 lakh of earning. P ratio into earning is called market capitalization or market value. P ratio into earning. P ratio into earning. You will study in financial management subject. That is how companies are valued. Earnings 20 lakh multiplied by price to earning ratio 12 times. 240 lakh is the purchase consideration paid. This is one method of computing purchase consideration. 240 lakh. The consideration was settled by Air Limited by issuing 8% debenture for 140 lakh at par and the balance by issue of one equity share based on its market value of 2.50 each. So point number B, write down discharge of purchase consideration. Discharge of purchase consideration. Under that write down 1 debenture. Debenture issued 140 lakh. debenture issued 140 lakh. Out of 240 purchase consideration payable, they issued debenture of 140 lakh. And what about equity shares? They have issued equity share balance amount 100 lakh. 100 is balancing figure, 240 minus 140, and the issue price is 2.50 each. Issue price is 2.50 each. So you take 100 divided by 2.50. 100 divided by 2.50, 40 lakhs shares into 2.50. So the total comes to 2.240 lakh. Total is 240 lakh. So I will just read the answer again for you. The purchase consideration is based on a formula called P multiple, that is earnings multiplied by P ratio. Earning is 20 lakh, P ratio is 12. So total amount payable is 240 lakh. Out of that, debenture issued 140 lakh and equity share issued 100 lakh. To issue equity share, one equity share will be issued at 2.50 each. So number of equity share issued is 40 lakh. So this is the first working. This is for acquiring 100% stake in Cold Limited, 240 lakh. Dry Limited. Next is Dry Limited. The market value of Dry Limited on 1st October 2009 was mutually agreed as rupees 375 lakh. Air Limited satisfied its share of 50% of this amount by issuing 75 lakh rupees 1 equity share, market value 2.50 is to Bag Limited. So now write down step 2. In your notebook, please write down step 2. Purchase consideration paid to acquire 50% stake in Dry Limited. Who is Dry Limited? Joint venture. Dry Limited is joint venture. Rupees in lakhs. First point A. Purchase consideration. Purchase consideration is 50% of 375 lakhs. The total value of Dry Limited is 375 lakh. The total market value is 375 lakh, but you have only acquired 50%. So that comes to 187.50 lakhs. And this was satisfied by 75 lakh equity share of rupees 1 each issued at 2.50. So point number B. Discharge of purchase consideration. Discharge of purchase consideration 75 lakhs shares at the rate rupees 2.50 each. So that is 187.50. Discharge of purchase consideration 175 lakh share at rupees 2.50 each, 187.5. Okay. Now next line. So I hope you have written down step number 1 and step number 2. Step number 3. Air Limited has not recorded in its book the acquisition of the above investment or the discharge of consideration. So now what the student has to do? The student has to first record this transaction and then do the consolidation. So step 3, write down journal entry for recording acquisition of cold limited and dry limited. Journal entry for recording acquisition of cold limited and dry limited. So right hand side rupees in lakhs. Right hand side rupees in lakhs. Listen to me carefully. You have made two acquisition, but you have not recorded it. So now we are going to record like this. Please write down for understanding, not written in the institute answer. Investment in cold limited account debit. Investment in cold limited account debit. So you have paid 240 lakh. So the value of investment in cold limited is 240 lakh. Then write down investment in dry limited account debit 187.5. 187.5. 2. You have issued debenture. You have issued debenture of 140 lakh at 8% interest rate. So to 8% debenture, you have issued 8% debenture of 140 lakh. That will also be recorded. 2. Equity share capital. To equity share capital, now understand, you have issued 40 lakh share to acquire cold 40, and you have issued 75 lakh share to acquire dry. So it will be 40 plus 75 into rupee 1, that is face value. 40 plus 75, 115, and to securities premium, because shares were issued at 2.50, securities premium will be 115 lakh shares into 2.50 is the issue price, 1 rupee share capital. So multiply, the share premium would be 172.50. The share premium will be 172.50. This is the journal entry for recording acquisition of shares in cold limited and dry limited. Is it right? Is it understandable? So let us read further. So which means when you are going to do consolidation, these 5 numbers will also be first considered in the books of Air Limited. These entries are passed in the books of which company? Books of Air. If you have not understood, you can write. These entries are in the books of Air. So Air Limited share capital will increase, debenture, one new item will come, securities premium will increase, and 2 investment will appear. Now they have written the summarized financial statement of the 3 companies on 30th September, means after 1 year. You see the date of acquisition is 1st October and this balance sheet date is 30th September 2010. So 1 year is over. 1 year is over. The current year profit earned by subsidiary and joint venture will be post acquisition profit. Balance sheet is easy. Asset side, tangible asset, inventory, debtor, cash. Liability side, equity share capital, 1 rupee face value, retained earning, trade and other payable, overdraft, provision for tax. The following information is relevant. The book value of the net asset of Dry and Cold Limited on the date of acquisition were considered to be a reasonable approximation to their fair value. So right here, no adjustment required. This is just given for information. No adjustment required. So point number A is given for time pass. it won't affect your answer. We in India compute goodwill or capital reserve on the basis of book value only. On the basis of book value, that is whatever is appearing in the balance sheet. We do not use fair value. So that line was irrelevant. The current profit of cold and dry means current year profit of these two companies are 80 lakh and 20 lakh respectively. Look at the balance sheet of cold. Retained earning is 150 lakhs, middle column, liability side. In the balance sheet figures are given in thousand, but I am going to write the answer in lakh. So this is only 150 lakh and this is 45 lakh. So out of 150, post acquisition is 80 lakh, this one current year. So pre-acquisition would be 70 lakh. And in case of dry, the total profit in the balance sheet is 45 lakh. Post acquisition is 20 lakh. So pre-acquisition would be 25 lakh. If you can understand this much, then my answer is over, because there is no other adjustment in the problem. Now it says Dry Limited is a jointly controlled entity, will be accounted using proportionate consolidation method. Again, this line was not required. We are going to do the same. Goodwill in respect of acquisition of Dry Limited has been impaired by 10 lakh. So reduce goodwill by 10 lakh. Impaired means reduced. Okay, its value has gone down. Gain on acquisition, if any, will be separately accounted. Gain on acquisition means capital reserve. If there is a capital reserve, show separately. If there is a goodwill of dry, reduce it by 10. So this is only one adjustment given, and the other adjustment, like every consolidation problem, you have to divide the profits of subsidiary and joint venture in pre and post acquisition portion. Prepare the consolidated balance sheet of Air Limited and its subsidiary and its joint venture. They have not written joint venture, but you have to consolidate joint venture also on 30th September. Student will remember we have prepared 3 steps. Now I am going to prepare few more steps and then we will prepare the consolidated balance sheet. Is it right? Are you ready for additional steps? Okay. So write down please step number 4. Calculation of goodwill or capital reserve. Because we are going to consolidate subsidiary, goodwill or capital reserve dash Cold Limited, and Cold Limited is our subsidiary. Right hand side rupees in lakhs. First write down cost of acquisition. Go to step 1. Step 1 you will find 240 lakh. Point B, let's share in net assets on date of acquisition. Under that 2 points, share in share capital, but we are holding 100% share capital, 100% of 200, 100% of 200 is 200, and B write down share in pre-acquisition profit, 100% of total profit in the balance sheet is 150. Out of that, current year profit is 80, which means 70 was pre-acquisition profit. So 70, this total 270, total B. So this time we have a capital reserve. Capital reserve 30. If I do A minus B, capital reserve in case of Coal Limited is 30. Is it right? Then you write down step number 5. Calculation of goodwill or capital reserve in case of Dry Limited, which is our joint venture. Calculation of goodwill or capital reserve dash Dry Limited, which is our joint venture. So write down right hand side rupees in lakhs. First write down A, cost of acquisition in bracket step 2. If you go to step 2, you will find 187.50. Point B, share in net asset on the date of acquisition. Share in net asset on the date of acquisition. So write down share in share capital we have acquired 50% only. So 50% of share capital of Dry Limited is 250. Don't miss this question. If they ask again in the exam, you will get 16 mark. Inform your friends also to revise. Share in pre-acquisition profit, that is 50% of 45 minus current year profit is 20. 50% of 25, 12.5. Total B is 137.5. Below that write down, below that point number C, it's not over, goodwill. 187.5 minus 137.5. So you will get goodwill 50 lakh. But there is one adjustment in the problem. Goodwill will be impaired by 10 lakh, less goodwill impaired. Impaired means written off by 10. Therefore, goodwill after impairment. Therefore, goodwill after impairment will be 40. Goodwill after impairment will be 40. Step number 6 write down. Consolidated reserve and surplus balance on 30th September 2010. Now we have to also find out how much will be reserve and surplus. We have to find out how much would be reserve and surplus on the date of consolidation. So how do I find it? I have to first take reserve and surplus of parent company Air Limited. Air Limited full amount, reserve and surplus, retained earning rupees in lakhs 208. Reserve and surplus 208. Then we are going to add share in post acquisition retained profit of share in post acquisition retained profit of Cold Limited. We are holding 100% share in Cold and current year profit is 80 and current year profit is 80, so that is 80, same amount. Point number B, write down Dry Limited. In Dry Limited we are holding 50% and current year profit of Dry in point number B in question 20 lakh, so that is 10 lakh. And this goodwill 10 we have written off, so that will be having a second effect here in step 6, less goodwill written off. Goodwill written off will reduce the consolidated retained earning by 10. So what is my total consolidated retained earning? 208 plus 80 minus 10 plus 10, 288. 288 will appear in the balance sheet. 288 will appear in the consolidated balance sheet. So we have completed all the steps, and now this will be very useful for preparing the consolidated balance sheet. Just go through it once, see if you have understood everything. Now we are going to prepare consolidated balance sheet. Write down consolidated balance sheet as at 30th September 10. As at 30th September 10. Write down rupees in lakhs. Write down note number here. First, we'll draw the format as per schedule 3. In your booklet, the format is old format. You will not follow that in the exam. You will follow schedule 3 format. So first you write down point number A. Equity and liabilities. Equity and liabilities, under that one, shareholders funds. Under that small a, share capital note 1, B, reserve and surplus, note number 2, C, or point number 2 write down non-current liabilities. Under non-current liabilities you write down A, long-term borrowing. Do you find any long-term borrowing in the given balance sheet? You will say no, but you are forgetting we have issued one 8% debenture. We have issued one 8% debenture. So that 8% debenture issued by Air Limited will come in the balance sheet. So I have written directly here. You can prepare a note also if you want. Then point number 3, current liabilities. Current liabilities you write down A, trade payable. Note number 3, we write down short-term borrowing. Note number 4, for bank overdraft we'll write short-term borrowing. There is only one item, so I can write here only. No need to prepare a note. But if you want to prepare a note, I will not stop you, because there is only one item in overdraft. I don't have to do any adjustment. 1540. Point number C, write down short term provisions, note number 4. Then write down total. Point number B, write down assets. Under asset, write down 1. Under assets, write down 1. Non-current assets. Under that, write down PPE. PPE, note number 5. Point number 2, write down current assets. A, write down, and below PP write down one more line. B, goodwill. Goodwill. Goodwill we have computed in step number 5. Step 5, goodwill 40 lakh. Goodwill step 5, 40 lakh. Goodwill step 5, outer column 40 lakh. Current asset, write down inventories, note number 6. B, trade receivables. Trade receivable, note number 7. And C, cash and cash equivalent, note number 8. And then total. So these are the minimum notes we have to prepare for solving this question. So write down please. Notes to account. Notes to account, right hand side rupees in lakhs. Note number rupees. First note, share capital. Under that write down authorized. Just write down dash double underline. Issued, subscribed and paid up. In the balance sheet of Air Limited, there are already 100 lakh shares. Can you see that? 100 lakh shares. And plus 115 lakh share we have issued on acquisition of cold and dry. So 215 lakh shares we'll have now. 215 lakh shares of rupee 1 each. Of rupees 1 each. So that is 215, and you write a note. Out of above 115 lakhs shares were issued otherwise than in cash. Out of above 115 lakh shares were issued otherwise than in cash. So 215 you write down here on the main balance sheet, 215. And now write down note number 2. Reserves and surplus. So here A, write down retained earning. Do you remember retained earning? We have prepared a working note, retained earning here, step 6. 288, 288. Then next is, there was a capital reserve in our calculation. Capital reserve, I will show you. Capital reserve 30 here, step number 4. Capital reserve, step 4, 30. Retained earning, step 6, 288. And one more line, write down securities premium. Securities premium, you will have to go to step 3, journal entry. Go to step 3, journal entry. We have recorded, I will show you. Can you see on the right side below 172.50? Securities premium will also come now. So the student will write 172.50, and you have to take this total in the outer column. 288 plus 30 plus 172.5, that is 490.5. This 490.5 write on the main page. Then debenture I have written. Next, note number 3 is trade payable. Note number 3, write down trade payable. Under that you write down Air Limited full. Trade payable of Air Limited is 171.20. Cold Limited full, it is our subsidiary 100%, 52.70 full. And Dry Limited, we will only add 50% of 141, 50% of 141, 70.5. Dry Limited proportionate consolidation. So you will take the total 171.20 plus 52.70 plus 70.50. So that comes to 294.40. 294.40 is right. Trade payable 294.40. And now note number 4, short term provision. Short term provision. Note number 4, short term provision. Under that you write down provision for taxes. Provision for taxes. Under that write down A. We have Air Limited full. Air Limited full 56.4. Cold Limited full, because it's our subsidiary 100%, 24. And Dry Limited half. Take on your calculator 50% of 7.60, 3.80. Take the total 56.4 plus 24 plus 3.80, and that is 84.20. 84.20. So let us come to main page, 84.20. And now I will add the liability side. Add the liability side. Only this overdraft figure we have to write 15.40. 15.40. Because we are writing in lakhs. Please add the balance sheet and give me the total. Add the balance sheet, everybody, come on. Balance sheet total is coming to 1239.50. 1239.50. 1239.50. Now we'll come to Note number 5, PPE. Under PP write down Air Limited full 342.6, Cold Limited full 270, Dry Limited half, Dry Limited is joint venture, 50% of 210.60, 105.30, the total is 717.90, 717.90. Then we'll come to note number 6. Inventories. Air Limited 96.4, Cold Limited full 72, Dry Limited 50% of 186.4, 93.20, total on the outer column 261.60, 261.60. So we'll go to previous main page, 261.60. Next, note number 7, trade receivable. Air Limited full 112, Cold Limited full 50.60, Dry Limited half, 50% of 46.20, 23.10, take the total 185.70. Write on the main page 185.70, and the last note is 8, note number 8, cash and cash equivalent. Under that we have only two companies, Cold Limited full 34.10, Dry Limited half, 50% of 0.40, 0.20, so that is 34.30, 34.30, 34.30. Now take the total of the asset side, take the total of the asset side and see if it is tallying. $1239.50. Wonderful, it is tallying. This was a 16-mark question, and all the student must practice it 2 or 3 times before going to the exam, because it combines the knowledge of 2 chapters, AS21 and AS23. Okay, so today we'll stop here. Thank you very much.